Larry, do you think at some point that if all that money starts coming into these sectors, it could create a bubble-like situation in both of them?
Yeah, it could. I mean, it could. I was an internet investor. A guy gave me a business card in '93 with internet apps. And I said, "What's that?" I was a venture capitalist. And I was blown away, and I went and I started buying private internet companies in '94, and that worked out really well. And that became a bubble. And in 2000, I was getting out of the internet. And yeah, it could become bubbly here, no question. I think we're a long ways away from that. I mean, in baseball terms, people said, "Where are we?" I mean, I think we're somewhere between the second and the third inning. So, that's a ways down the road in my estimation. But yeah, definitely, because humans don't change, and people chase trends and they chase performance. And I often think to myself, boy, what happens when the Robinhood crowd gets on board with gold-related stuff and sees how well it's doing? I mean, to an extent, the Robinhood crowd is what's driving cryptos, right? I mean, Bitcoin is young person's gold, right? I mean, it's a technology. It's a play on fiat, money going to zero, but it's also a play on a technology, that makes moving large sums around easier. And doesn't involve storage costs and so forth. It's I don't know. Did that answer your question?
Yeah. So, Larry, could we see the S&P and tax revenues fall in tandem? Why would this be, and how are they linked?
Well, very much so. I mean, I think Luke Roman points this out a lot. That I think the S&P is almost a policy tool of the United States government. I mean, they need to have the government going up, or else this economy. That's what I don't think people understand, is just how many steroids have been injected into this economy. And if they don't continue injecting steroids, this economy is going to fall over and die. I mean, if the S&P were to go down 50% right now, and think of the reverse wealth effect of poor people, oh my God, it would be a horror show. And so they need to keep, in my report that's coming out, they need to keep the stock market going up. They absolutely have to, or else the deflationary forces will overwhelm things. And so, I think there's a greater chance that we have a Venezuelan or a Weimar-like, and I show these charts on my quarterly, melt up in stocks. And look, stocks are better than bonds. I mean, even in Weimar, if you owned, Daimler-Benz or not Daimler-Benz because it's small, but if you owned Siemens as an example, big industrial company in Germany, you'd have made it through, right? I mean, because stock is an ownership, a share in a business that, when the currency gets repriced, the shares will still have value in the new currency. Mm-hmm. So, I mean, they may have, in the middle of the melt up, they may have lagged or been behind, but if you held your shares, you owned a share of a business. And so in that respect, stocks are not the worst thing to own in hyperinflation. Bonds and cash are. But, obviously, in my opinion, the gold stocks will be much better than just the average stocks. And, I think that there are clearly some stocks that have bubble-like characteristics today out in the marketplace. I mean, it's stunning to me how this free money has driven the overall stock price.
Mm-hmm. So, Larry, as you're talking about the gold stocks there, can you share with us some of your criteria on how you evaluate these companies to invest in?
I mean, so first of all, this is a very tough industry. It's a very shitty business. I mean, it's breaking rocks, and you got all kinds of risks. I mean, there are more Murphy's Law items in this area than you can imagine. And in general, I wouldn't be interested in it unless you had an enormous macro tailwind, which I think we do here. Mm-hmm. So I think, the macro tailwind is going to make up for a lot of sins. Having said that, the lowest risk category within the thing, and I've said this in many interviews on the web, but I'll repeat it because it's important, is to find what I call emerging producers. And so these are, there are three buckets, right? There are companies that are producing cash flow. There are companies that are trying to develop a mine to produce cash flow. And there are companies that are drilling good rocks to show that they've got a big deposit. So, producers, developers, drill stories. The producers, emerging producers are the sweet spot, the best reward for your risk. So you find a company that's producing gold, and that, you get a couple of benefits. One, their production might grow. And two, they've got operating leverage from higher gold prices. And three, they often sell at low multiples. Barrick and Newmont sell at 10, 11, 12 times cash flow. I've got a lot of companies in my portfolio that are selling between 2 and 6x cash flow. That's because they're small, they're not well known, et cetera. As they grow and become better known, become more powerful, those multiples will expand. So, gold stocks go up for three reasons. They go up because the price of gold goes up. They go up because their production increases, therefore their cash flow increases. Or they go up because the multiple people are willing to pay for them goes up, multiple expansion.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
And so if you can find a small growing gold stock with increasing production, selling at a low multiple, that's your greatest chance for multiplying your money. Having said that, they all have risks, and so I would never advise anybody to be in any less than 10 or 15 of these things. You want to find a bucket of them that all look similar, knowing that out of that 10 or 15, 2 or 3 of them will fail. 2 or 3 of them will give you average returns or low returns, and then a couple of them will really hit it hard and become 5, 10, 15 baggers. And if you take all that money and blend it together, you can have a good rate of return. So that's the lowest risk area. In parts of the cycle, being in the drill stories is the quickest, easiest money, but there's a lot of risk associated with it, and you got to really understand the geology and know how to pick them. But you can multiply money very quickly in drill stories as well. You can also strike out. So and in that area, I wouldn't advise it for people who don't really understand the business and don't have a geological context and or people helping them to understand drill stories. So.
Mm-hmm. Larry, do you think that a lot of those, let's say, high points in those stocks are going to come at relatively the same time if we see a very high gold price, or is there going to be a different way to, really have to, let's say, evaluate each one of these holdings as they go?
You're going to have to kind of evaluate, move around. And I'm pretty heavily into some drill stories right now because I think we're in the second inning, and I think we've got a lot of room in front of us, and they're still quite cheap relative to the resources they have. Mm-hmm. So I think that's very good. In 3, 4, 5 years into the cycle, I probably won't be into the drill stories as much because one, they won't be as cheap, and two, the market will be moving towards cash flow, in my opinion, and mm-hmm. So. I think the producers and developers will become a better place to be as we get further on. I mean, all of these, in all these situations, Tom, you're really trading off upside, downside. I mean, and asymmetry, as you pointed out earlier, asymmetry is what you're going for, right? Mm-hmm. Trust me, in every gold stock, you can lose all your money. These are not SaaS software businesses where if things go bad, you're going to go sideways and get sold to somebody else. Mm-hmm. If you're wrong, you're going to get wiped out. So and people need to understand that. I mean, it looked like easy money, but it's not. However, if you're right, if you've done your analysis and you're right, and I don't go into anything where I don't think it's going to double at least. Mm-hmm. And I've got things that could be 4 to 10x. And, it depends on a lot of things. It depends on getting the new plant going. It depends on developing the new mine. It depends on the gold price, politics, etc. But the point is, if they work, and it depends on multiple expansion. If they work, I mean, when they work, it's a very powerful thing. I mean, go look at the chart of Kirkland Lake. Go look at the chart of Weston. I mean, I was in both of them. I'm not in either one of them now. They're too pricey for me. Mm-hmm. They're good companies. I mean, people who buy them will do fine. They will trade with or above the market because they both have excellent management teams. But the point is that if you're looking for alpha in the space, you want to find those emerging producers. Before everyone else finds them, when they're still cheap enough to have real multiple expansion. Mm-hmm. And then also you want to get your macro timing right. And by the way, I think we got our macro timing right. I mean, here's another statistic that I think is really important to blow people away. Typically speaking, a gold stock is a flow of funds out of a company that produces gold, right? Mm-hmm. So, just economic theory, you own a lump of gold, it doesn't change. It goes up or down based on its relationship to the dollar. You own a gold stock, it has a stream of cash flows in theory going forward, depending on the price, that you can discount back. So what am I getting at? Well, if gold goes up 10%, a gold stock ought to go up 30%. Gold stocks ought to go up 30%. It's just kind of a rule of thumb. Why? One is a fixed amount, it's like cash, and the other one is an operating company that's throwing off cash. And so, a 10% move in the cash ought to generate about a 30% move in the stock, maybe more, but 30 seems to be the average over a lot of cycles. This past year, excuse me, gold went up 25%. GDX, the big gold stock index, went up 23%. So what that informs me is that people still don't believe in gold stocks. I mean, they're still looking at this. I call it battered gold bull syndrome. They're still looking at this and saying, well, this is a shitty business. And these managers fucked it up last time. So I don't want to play. And so what should have happened is gold, the GDX should have been up 75% this year, but it wasn't. And so it's still, as much as people look at my results, they say, well, Jesus, we had a couple good years. Have I missed it? Like, no, you haven't missed it. I mean, now 3 years from now, it's not going to be as easy. We're not going to be buying things at 4 times cash flow. And, it's not going to be, just almost by definition, as the prices get higher, the risk reward gets worse for a new buyer. But we'll deal with that 3 years from now. I mean, I expect my portfolio to be a couple turns from then, from where it is today at that point in time. And maybe there might even come a time to exit this. I mean, there'll be, there might be sound money alternatives coming. Gold might not be the place to be if it looks like we're going to get a system that's, restructured. But, you deal with all those as you go along. I can say with high confidence right now that for people making placements in this area, I think your timing is good and you're going to do well. You obviously wouldn't have done as well if you did it, and I had some people, of course, join my fund in August, and they're just back to break even. But, from August until now, there was a correction, right? It came in substantially. And so, and I was selling some things in August and it's human nature, right? I mean, it's when it gets totally to a boil, eventually at some point it'll find a point where there are no more buyers and it's going to correct. I mean, this will happen with Bitcoin. I don't know where. I don't know if it's at 38 or 75 or 100, or if you believe Max Kaiser, it's at 220. I don't think this run goes that high, but I'm still buying at this level, on a kind of a consistent basis. A lot of my investments, I like the dollar cost average. So, and I do believe longer term Bitcoin is going to work. So there are risks, but I think we'll overcome them.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.